All right, so we're diving into value investing today. I've got this stack of sources you sent over, and there's always this mystique around it. Like you find these hidden gems, buy low, sell high, become the next Warren Buffett. It sounds pretty simple, right?
Right, yeah, that's the allure, isn't it? It seems so straightforward. But I think as we dig into these sources a bit, you'll see it's a lot more nuanced. One of the things that really stood out to me was, well, statistically, more people have actually lost money trying to be like Buffett than have actually made money.
Wait, really? More people lose than win. Okay, now I'm really intrigued. I mean, if it were that easy, wouldn't we all be, on our yachts by now? So what's the catch?
That's a great question, and I think it highlights a really important point. Value investing, it's not just about understanding the concept. It's about, it's about developing the judgment to actually apply it. One source I was looking at called it judgment-based capital.
Judgment-based capital. I like that. Break that down for me. What does that mean?
It means that your returns are driven by, well, by the quality of your decisions, not just how much money you put in. So it's not just about the capital. It's about aligning it with good judgments. And that takes work.
So it's not as passive as some folks might think then.
Exactly. One source even compared it to like running a business. You wouldn't just, throw money at a business and expect it to magically succeed, right? You have to make decisions about operations, strategy, hiring, all that. Investing with judgment is, well, it's kind of similar. You need effort, research, and you have to accurately assess a business and its potential.
That makes sense. I can see why just blindly following someone like Buffett might not be the best strategy.
Mhm.
So how do we develop that judgment-based capital? Where do we even start?
Well, one of the sources of defined value investing is find the difference between what a company's really worth, its intrinsic value, and its market price. That's where we start.
Okay, intrinsic value versus market price. But how do we determine intrinsic value? Isn't that kind of, subjective?
It can be, but there are frameworks for analyzing a business to try to figure out its intrinsic value. One source used a really helpful analogy comparing owning stocks to owning like rental properties.
Yeah.
So you buy a property and you rent it out, you generate income, and hopefully the property goes up in value over time.
So we're not looking at stocks as just, pieces of paper to trade, but thinking like a business owner, we're assessing the long-term potential of our, I guess you could say, our property.
Exactly. And that actually leads into another important concept from the sources. What makes a company good, in terms of value investing?
Yeah, right. Because we're not just buying any stock, right? We're looking for companies that are actually worth owning,
Yeah.
businesses that are, built to last. So what makes a good company in the eyes of a value investor?
One source broke it down into two key components: a strong business model, they called it a moat, and a healthy corporate culture.
Okay, a moat. I like that. What does that mean, though, in business terms?
A moat is like a company's competitive advantage. It's something that sets it apart and protects its profits from competitors. So it could be a strong brand, maybe a unique technology, a loyal customer base, or some combination of all those things.
So finding companies that have something special, something that gives them an edge, in the marketplace. What about this corporate culture piece? Why is that so important?
Well, a healthy corporate culture, it's important because it speaks to how sustainable the business is in the long term, you know? So you're looking for companies with ethical leadership, a focus on innovation, a culture that can, attract and retain talent. And all of these things, they help a company deal with challenges and adapt as the market changes.
That makes sense. If you're thinking long term, you want to be sure that the company's, built on solid ground, not just riding some, temporary wave.
Exactly. But even if you have a strong business model, a healthy culture, you still need to figure out how much to pay for the stock. And that's where intrinsic value comes in.
Okay, so let's break down this intrinsic value thing. You mentioned it before, but how do we actually, figure out what a company is worth?
Imagine you're buying that rental property,
Hmm.
right? You wouldn't just look at the asking price. You'd also think about the location, what condition the property's in, how much rent you could charge.
Right, right. You want to estimate how much income it could generate over time.
Exactly. And figuring out intrinsic value in the stock market, it's similar. You have to analyze a company's financials, its growth prospects, how much cash flow it can generate in the future. And one way to do this is, well, it's called discounted cash flow. It's basically projecting future earnings and then discounting them back to their present value.
So we're trying to look into the future, estimate how much a company will earn down the road, and
Right.
then use that to figure out what it's worth today.
Exactly. It's about looking past the noise of the market
Yeah.
and focusing on the real value of the business.
That sounds pretty complex, especially, considering all the unknowns about the future. How do we even begin to project a company's earnings years down the line?
It's not an exact science for sure, and that's where judgment comes in. You have to consider a lot of factors, like industry trends, the competition, the overall economy. But this is also where that moat concept we talked about becomes really important.
Because a company with a wider moat, a stronger advantage, it's probably going to be more resilient and predictable, right? At least with its future earnings.
Exactly. The stronger the moat, the more confident you can be in those projections.
Hmm.
But there's another big element we need to consider, and that's, well, the market itself. It can be unpredictable.
Right. Even if we find the perfect company and calculate its intrinsic value perfectly, the market doesn't always, play by the rules. Stock prices go up and down all the time. Sometimes it seems like for no reason at all.
And that's where one of the most famous ideas in value investing comes in. Benjamin Graham's Mr. Market metaphor.
Mr. Market. Yeah, I've heard that before. Honestly, though, I'm a little fuzzy on the details. Can you refresh my memory?
So imagine Mr. Market as this, well, as this really emotional character. And he shows up at your door every day offering to buy or sell you stocks. Some days he's euphoric, super optimistic, willing to pay top dollar for anything. Other days he's gloomy, pessimistic, practically giving stocks away.
So he's like driven by pure emotion then, completely detached from the actual value of the companies. That sounds a little chaotic.
Exactly. And the key to value investing is to not get caught up in Mr. Market's mood swings. You have to be able to, to see through all that. You have to focus on your own assessment of a company's intrinsic value.
So we need to detach ourselves from all the hype and the panic, right?
Yeah.
Right? Resist the urge to follow the crowd, whether everyone's buying or selling.
Exactly. You got to be disciplined and patient. Wait for those moments when Mr. Market's emotions create a gap between the market price and the intrinsic value. That's when you can, buy low and hopefully sell high later on.
Okay, that makes sense. I can see how it would be tough to stay calm and rational when everyone else is, losing their minds, whether it's euphoria or panic. How do we avoid getting caught up in that?
Well, that's where another core principle of value investing comes in, the margin of safety.
Margin of safety. Okay, now you've got my attention. Tell me more.
Think of it like this. Imagine you're an engineer and you're designing a bridge. You wouldn't just build it to handle the expected weight, right? You'd build in some extra capacity just in case to account for, unexpected events. You'd want that margin of safety.
So you're building in a buffer, basically, to protect yourself from risks you can't really predict.
Exactly. And the same idea applies to value investing. You're assessing intrinsic value, but you don't want to just buy at that estimated worth. You want to buy at a discount with a margin of safety built in.
So even if we're a little off with our intrinsic value calculation or something unexpected happens, we've got that buffer to protect us.
Exactly. It's all about minimizing risk, acknowledging that, even the best analysis can't predict the future perfectly.
Okay, I'm starting to see how these pieces fit together. We find companies with strong business models, healthy cultures, assess intrinsic value based on long-term earning potential, and then buy them with a margin of safety to kind of weather Mr. Market's mood swings.
That's a great summary of the core principles so far. But to really understand how these principles work in practice, we need to look at, well, the master himself, Warren Buffett.
Now we're talking. Buffett's like the poster child for value investing. What can we learn from his approach?
One source highlighted something fascinating. It's not just that he follows these principles, it's that he's almost obsessed with minimizing uncertainty. He sees other market drivers as well as potential threats.
So he's not just playing the game, he's trying to like stack the deck in his favor.
Exactly. He builds layers of protection into his investments. Like he often goes for things like preferred stock holdings, which give him priority over common stockholders if a company has to liquidate.
So it's not just finding a good company, it's about, structuring the deal so he has more control, less risk.
Precisely. And another source pointed out his leverage through his insurance businesses. They provide him with this steady stream of float. It's basically premiums from policyholders that he can invest while he's waiting for claims to be paid. It gives him a huge advantage over most investors.
Wow, that's another level of strategic thinking. Like he's playing chess while everyone else is playing checkers. But with all his experience, all his resources, does he still make mistakes?
Of course. Even Buffett isn't perfect. But one thing that really stands out is his high bar for making investment decisions. He wants to be able to predict future performance with at least 90% confidence.
90%. That's a high standard. Most
hmm
folks would be happy with, 50-50. What does that tell us about his approach?
It shows his commitment to minimizing risk. He only invests when he really understands the business and has a high degree of certainty about his future. He's not swinging for the fences. He's looking for those singles and doubles he can hit consistently.
Makes sense. But with all this talk of, long-term thinking, minimizing risk, how do value investors handle the ups and downs of the market? We can't predict the future. What if something unexpected happens, like a pandemic or a sudden economic downturn?
That's a great question, and it gets to the heart of long-term thinking. One source asked this really thought-provoking question. Would you still invest in a company if you knew you couldn't sell the stock for 10 years?
10 years. That's a long time to be, you know, locked into an investment. Honestly, it makes me kind of nervous just thinking about it. Why would they ask that?
It's a brilliant way to make you shift your thinking from, short-term speculation to long-term ownership. Value investing is not about quick profits. It's about buying into businesses that you believe are going to generate value over time, even if the market takes a dip.
So it's about having the conviction to stick with your investments,
Yeah.
even when things get a little rocky.
Exactly. And remember, most of Buffett's wealth, it was accumulated after he turned 50. It takes time for those compounding returns to really, kick in.
Okay, that is encouraging. Patience really is a virtue, especially in the world of investing. But, sometimes it feels like the market's moving so fast, new technologies, new trends, companies popping up all the time. How do value investors stay ahead of the curve without, getting caught up in all the hype?
That's where avoiding unnecessary assumptions is crucial. One source talked about projecting a company's future based on, some unproven product launch.
So stick to the facts, to what's known and proven. Don't build your whole investment thesis on speculation.
Precisely. Value investors, they tend to favor companies with enduring brands, consistent cash flow, a history of navigating those market cycles. They look for stability and predictability, not just the next big thing.
That makes a lot of sense. It's about investing in companies that they've shown that they can generate value over time, even when things change, even when there's disruption.
Exactly. It's not about gambling on the next big thing. It's about finding those businesses that are built to last.
What's fascinating to me is that this isn't just about, investing in the stock market. It's a whole philosophy for making decisions. One of the sources really, really emphasized that point.
Absolutely. You can apply the principles of value investing to any decision where there's uncertainty, whether you're choosing a business partner, making a big financial decision, even navigating, your relationships.
So it's not just about picking stocks, it's about making choices that line up with our values. Choices made with a long-term vision and with a commitment to making informed decisions. It's about living intentionally, thoughtfully.
That's a beautiful way to put it. And, one of the sources offered this really, really powerful question to kind of guide this whole process. They asked, how confident am I?
Wow, that is a powerful question. It makes you really examine, your level of certainty. Make sure you're not just jumping into something.
Exactly. It forces you to do your homework, gather all the information, analyze everything, do your due diligence before you make a move. And if your confidence is low, maybe that's a sign to slow down, get more information, or even walk away.
It's like that margin of safety, but,
hmm
applied to our decision making. Don't just cross that bridge because it looks sturdy. You got to make sure it can actually handle the weight.
That's a fantastic analogy. And this idea of confidence, it ties back to another key principle from the sources, honesty.
So being honest with ourselves about our abilities, our limitations, the risks involved.
Exactly. Acknowledging what we don't know, being willing to ask for help,
Mhm.
not pretending to have all the answers. That kind of honesty, it's crucial for making sound judgments.
And being honest with others too, right? Upfront about our intentions, the risks, the downsides as well as the upsides.
Absolutely. Honesty builds trust. And trust is the foundation for any good relationship, whether it's business, personal life, or, investing.
This has been an incredible discussion so far. We've covered a lot of ground, the core principles of value investing, the challenges, and even how those ideas apply beyond the stock market. But there's more to unpack here. We're going to keep this conversation going.
It's fascinating how these complex financial principles we've been talking about, they really just come down to making good decisions.
Yeah.
In any part of life, I mean.
That's what I'm really enjoying about this conversation. This idea that we can take this value investor mindset and use it to make better choices in all areas of life. One of the sources even talked about using this approach when you're, evaluating potential business partners.
Yeah, it makes perfect sense when you think about it.
Yeah.
Just like you wouldn't buy a stock just because of hype,
Yeah.
right? You shouldn't just jump into a partnership without really looking at the intrinsic value, so to speak, of the person.
So instead of getting swept up by, a fancy presentation or someone who's a smooth talker, we should be digging deeper, looking at their track record, their work ethic, their values, all those fundamental things that really show their long-term potential as a partner.
Exactly. And you have to watch out for those Mr. Market moments, in business partnerships too.
Yeah.
Times when the hype inflates their perceived value, way beyond what they're actually capable of.
Oh, I've seen that happen. Someone gets a little success and suddenly everyone wants in. Their perceived value just skyrockets, even if their fundamentals haven't changed. It's like that fear of missing out thing driving up the price, just like in the stock market.
Right. And that's where that disciplined value investor mindset can really help. Just like you'd want a margin of safety with a stock, you should look for that margin of safety in a potential partner too. Do they have a history of integrity? Do their actions actually match their words? Are they in it for the long haul, or are they just looking for a quick win?
Those are questions I should be asking myself more often, not just in business, but, in any relationship. And another source, this one actually went so far as to suggest using value investing principles when choosing a life partner. At first I was like, huh, that's a little strange. But the more I think about it,
It's not as weird as it might sound at first. Choosing a life partner, that's probably one of the biggest, most important long-term investments you'll ever make, right?
yeah, it's about finding someone who shares your values, whose
Yeah.
character you respect, who you can see yourself building a life with. Good times and bad times, really. It's a lot like the qualities a value investor looks for in a company.
Exactly. You're not looking for someone who's just, popular right now. You're looking for someone who's inherently valuable, someone whose worth goes beyond trends or superficial stuff.
I love how this conversation has gone beyond just picking stocks. It's about making choices that are in line with a deeper sense of value. It reminds me of that whole doing the right thing principle that kept coming up in the sources.
That's a really key point. Value investing, it's not just about making as much money as possible. It's about building success that lasts. And that's based on integrity, honesty, a commitment to creating value for yourself and for others.
So it's not about cutting corners or, finding loopholes. It's about operating with principles, making decisions that you feel good about, even if it's not always the easiest or fastest path.
Absolutely. And that's what makes this whole framework so powerful. It's about aligning your actions with your values and really thinking about the long-term impact of your choices, whether it's in investing or just life in general, I mean.
It seems like these sources really stress the importance of, staying grounded, avoiding those emotional extremes that can really mess up your judgment. One phrase I kept seeing was keeping a normal state of mind.
Yeah, that's a good one. It's about emotional regulation, not letting fear or greed, control your actions.
Because when we let our emotions take over, that's when we make those, impulsive decisions that we regret later on.
Exactly. Think about those Mr. Market moments. When everyone's gripped by fear, you might panic and sell, even if the companies are still fundamentally strong. Or when greed takes over, we might chase those hot stocks, ignoring our due diligence, paying inflated prices for companies that they don't live up to the hype.
So how do we cultivate that normal state of mind, especially in a world that feels, anything but normal sometimes?
One source had a really simple but powerful suggestion. They said to ask yourself regularly, how confident am I?
It sounds so simple, but I can see how that would make you stop and think. It forces you to step back from the emotion of the moment and really assess your level of certainty before you make a choice.
Exactly. It encourages you to look at everything. Gather the information, weigh the risks and the rewards, do your due diligence before you jump in. And if you realize your confidence is low, maybe that's a sign to slow down, maybe get more information, or even, walk away entirely.
Like that margin of safety we talked about, but applied to, to how we make decisions. Don't just jump in because it feels right at the moment. You got to have solid ground to stand on, intellectually and, emotionally.
That's a great way to put it. It's about making choices from a place of grounded confidence, not from fear or some kind of impulsive desire.
As we're talking about all this, I'm realizing how connected these principles are. The honesty, the confidence, the long-term thinking, focusing on doing the right thing. It's like they all reinforce each other.
It's a beautiful tapestry, isn't it?
Yeah.
And the more we look at these principles, the more we see how they can lead us to a more fulfilling life. And not just in our investments, but in everything we do.
Okay, I'm ready to keep unraveling this tapestry. What else do these sources reveal about this value investing mindset and how it can change not just our portfolios, but our lives? This deep dive into value investing, it's really opened my eyes to a whole new way of thinking about, well, everything, really. It's not just about money. It's about a mindset that can make life better, more successful overall.
It really is a shift in how you see things. And one source, it made this point that stuck with me. They said value investing is really about, finding true value in every part of life.
Not just chasing trends, or the flashiest thing, but looking for substance, for things that have lasting value.
Exactly. It's about making choices that match what matters to you in your relationships, your career, how you spend your time, all of it. It's about building a life on values, not just whims.
And that reminds me of something else that came up in the sources, common sense.
Aha, common sense.
Yeah.
The most undervalued thing there is, right? In a world that loves complexity, it's easy to forget how powerful simple wisdom can be.
Yeah, it's like we try so hard to be clever, to outsmart everyone, that we forget to just ask, does this make sense? Exactly. Value investing. At its heart, it's applying common sense to finance, looking past the hype, focusing on what's real.
And you can take that same approach in so many other areas of life. When you have a decision, big or small, just stop, look at it. Ask yourself, does this feel right? Does it match my values? Is it good for the long run?
Those simple questions, they can be really powerful. They help cut through all the noise, avoid mistakes, and make choices that are, well, that are true to yourself. It's about trusting your gut, but also doing your research,
Yeah,
being intuitive and analytical. You kind of need both to make smart choices.
that's a great way to put it. Finding that balance between, your head and your heart, intuition and reason.
So we're not saying be reckless. It's about being thoughtful, intentional with your choices.
Exactly. Taking responsibility for your decisions,
Hmm.
understanding what might happen, and making choices you can stand by. Now and later, I mean.
This makes me think back to keeping a normal state of mind, staying grounded, not letting emotions take over and lead to, impulsive actions.
That's so important. When fear or greed is in control, you're more likely to do things you'll regret later.
It's like that old saying, don't make decisions when you're angry, don't make promises when you're happy. Big emotions, they can really mess up your perspective.
Exactly. A balanced mindset helps you see things clearly. You can weigh the risks and opportunities, make choices that are truly good for you.
So it's about building that inner stability, calm in the middle of the storm. I know, easier said than done. But the sources, they seem to suggest it's something we can get better at, with practice.
Absolutely. One source even compared it to like building a muscle. The more you work on staying grounded, making calm decisions, the stronger that muscle gets.
I like that. It's encouraging,
Yeah.
that we can train ourselves to be more resilient, more level-headed, so we can handle those ups and downs in life with grace and wisdom.
Exactly. And that brings us back to, well, patience. That seems to be a big theme in all these sources.
Right. Value investing, it's not about those quick wins. It's the long game. You got to know that real value, it takes time.
And that's true for so much in life, isn't it? Building a business or relationship, learning a new skill. The best things, they take time, effort. You have to be willing to enjoy the journey, not just the destination.
It's trusting the process, knowing that even if you don't see results right away, your efforts still matter. It's like planting seeds, taking care of them, and knowing that, well, eventually they'll grow into something amazing.
And that ties back into what one source said, to live long and enjoy the compound interest of time.
What a great way to sum up this whole philosophy. It's about taking the long view, making choices that match your values, and trusting that with patience, with persistence, with a little wisdom, you can build a life that's truly meaningful.
I couldn't have said it better myself.
This deep dive, it's really been eye-opening. We started with value investing, and we ended up, well, exploring a whole philosophy of life. I hope everyone listening got something out of it.
It's been great exploring this with you. And remember, this whole value investing journey in the market and in life, it's about learning, adapting, and getting better at making judgments.
Until next time, keep learning, keep asking those tough questions, and keep diving deep.